Good afternoon and welcome everybody to today's webinar. Thank you for joining us. The webinar, of course, is titled End of Financial Year, the Budget and Beyond. My name is Steve Wright and I'll be your host for today's session. We're really pleased to have you with us as we head into the end of the financial year. And obviously it's a critical time for people to review their current position and look to make important financial decisions. I'm very pleased to say I'm joined on the panel today by two experts. Firstly, to my immediate left, Brent Hopping, who is one of our senior employee benefit advisors here at Certe, and also Sam Bai, who is Director of Accounting at Yarra Lane, a full-service accounting and wealth firm based in Victoria. So they'll be providing their expertise and insights today. What we'll be covering, and obviously it's pretty topical, is the recent federal budget announcements and what they could mean for you. We'll talk about some financial strategies that you can potentially do right now. But more importantly, we'll also talk about some of the longer term financial moves that you can do to set yourself up beyond the 30th of June and perhaps for each 30th of June as well. Our goal is to make it as simple and practical as we possibly can. And hopefully give some insights that are beneficial to yourself. Before we get underway, just a little bit of housekeeping. The session will be recorded, and for those of you who are with us, you will get a copy of that recording in the days following the webinar. I also need to let you know that today's session is one where we'll only be providing you general advice, and you'll see a general advice warning slide be on the screen in a moment. Also, there is a Q&A function. So if you look in the Teams window that you're currently viewing this through, you'll see a Q&A. That's being monitored by my colleague, Nick Weiss. And we've allocated some time towards the end of the webinar to answer all your questions. So please, as we work through today's webinar, put your questions in there and Nick will share those with Sam, Brent and myself towards the end of the session. Now, the other thing that I want to thank you all for, so as part of the registration process, we asked you a question whether you're concerned about whether the budget changes would impact you. And about 50% of you said that you were either slightly or moderately worried about those. And a further 25% said you were unsure. So we hope to unpack that today and give you a little bit of a better understanding around that. Given that, I also wanted to just point out that like anything, when there is major changes like there was in the budget, as it stands today, those changes are only proposals. So they need to be legislated and go through both houses of Parliament. So we would expect that before that happens, there will be some tweaks. And no doubt those of you who will be following the commentary over the news, etc., you would have seen that there's already been some noise that there's an expectation that maybe some of the proposals will get tweaked a little bit. Now, the final thing is, because they're not yet in place, it means that you don't need to make any panic decisions about any current investments that you have. You have time on your side to understand the changes. And of course, when those changes are finalised, you can seek help through your professional advisors. So with that, let's get into today's session. I thought, Sam, I might start with you. So given we're only a month out from the end of the financial year, what are some of the quick wins or some of the things our audience might be able to consider between now and 30th of June that might help them in terms of maximising their tax return?
Yeah, thanks, Steve. I think some of the really simple things that clients can often miss or forget doing is just making sure that they make any payments for tax deductible things prior to 30 June rather than paying them in July. So that can be things like your professional memberships, your income protection. I think really big one is about super contributions. So speaking to your advisor about potentially being able to make one of those and how that affects you. And the other one that's really common is bringing forward interest payments. I think with that though, often that's really can be a really useful tool. If you've got your income's higher this year for some reason, you might have got a bonus or sold an asset where you've got a capital gain. Getting that deduction this year might be more valuable than having it next year. So they're just a couple of few little simple things that people can do.
Great, thank you, Sam. One of the other things, or one of the things that came out of budget night before we talk about the big events, was the fact that those of us who are PAYG taxpayers, so which would be the majority of people I suspect on this call, that we could claim up to $1,000 in workplace deductions without the need for having receipts, etc. So who are the types of taxpayers who are most likely to benefit by that proposal that the government released on budget night?
Yeah, so essentially people that will benefit from that are people that claim less than $1,000 normally on their tax return. To be honest, though, we see with most of our clients, whether if they're working a little bit from home or have a professional membership, well, not most will generally claim over $1,000, but it has made it simple for their clients that or the taxpayers that have very little work-related expenses. Their employer might pay for their phone, pay for their memberships and whatnot. So those clients will get to have $1,000 deduction for nothing.
Yeah, that's really helpful. Thank you, Sam.
Can I just add to that though? It doesn't mean you shouldn't get receipts and maybe keep them, but you just don't have to prove it to the ATO.
Yeah, and I think that's a good point, Brad. The ATO don't give away money. I'm sure they've done their stats and worked out that 90% of people claim over $1,000. So whilst it might be easier, you might be costing yourself a bit of tax by not keeping your records.
Excellent. So obviously the two big announcements that were made on budget night, or the two big proposals, were the changes to negative gearing and to capital gains tax. So in a nutshell, what are those changes? Maybe I'll start with you, Brent, if that's okay.
Thanks, Steve. Yeah, those changes are effectively around capital gains tax and negative gearing on properties, or some properties going forward. So the critical dates though are budget night. Properties purchased post budget night, negative gearing will cease. If you've got a property pre-budget night, clearly it continues. The new CGT rules on property, and it's good to keep in mind that these two aspects don't work in lockstep. They are impacted differently, so separate them in your mind. New CGT rules as from the 1st of July 2027. Evaluations will need to happen on the 1st of July 2027 to take that into account. And this will impact far less Australians, but just in case, part of the budget announcement was that tax on discretionary trusts will change as of the 1st of July 2028.
Anything to add on top of that, Sam?
No, I think that Brent summarised those really well, and we're going to go into them in a bit more detail. But I think just further to what you said earlier, Steve, is that there is no need to panic and take quick action with any of these changes. They're being brought in a very reasonable, thought out process where there's plenty of time to make changes should you need to, and you're not advantaged to do anything today as opposed to in a year's time or 2 years' time.
Thank you. So I thought what we now do is obviously, because they are both quite significant changes, that we kind of break that up into firstly dealing with the negative gearing changes, and then we'll move into the capital gains tax. So Sam, in a nutshell, is negative gearing dead?
No, is the short answer. So essentially what the government with this budget changes have tried to bring in is to make it less advantageous for taxpayers to negatively gear properties. So for those who don't know what negative gearing is, essentially before budget night, I could go buy a property, the rent and rent it out. The rent for that property is taxable income to me, but then in turn I can claim my various expenses associated with it. Generally, the interest on it is a significant one, and for it to be negatively geared, that would mean that my costs outweigh the income that comes in, and then that loss that I make on the property, I can apply that as essentially a tax deduction against my salaried income. So it basically makes it cheaper to own and hold a property. So that'll still stay. If you've owned a property prior to budget night, you can rent out the property and apply those negative gearing benefits. For new properties purchased, so and when I say new properties, I mean a new existing property purchased post budget night, you won't be able to apply that loss to your taxable income. It will get quarantined until you either make a rental gain from the property or you sell the property and it reduces your capital gain. I think, and we've got there is an exemption for new builds where negative gearing and both the old capital gains tax rules will apply. And I think we'll talk about a bit more in another slide about what is a new build, but essentially I think for the people watching, the mindset to have with new builds is it's trying to add more supply of property. So it's generally, if it's created more supply of property, then it's considered a new build. If it's knocking down an old property and replacing it with one newly built property, then that doesn't qualify as a new build.
That's a really good introduction. I do think that is probably an area that people are unsure about, Sam. So I think the next slide does address that. So talk a little bit more around what does qualify under and again, just to reinforce it's only proposed, well, what does qualify under the new build and perhaps what doesn't?
Yeah, so the key thing is newly constructed dwellings, and essentially, as I just said, it's really things that have increased housing supply. So again, if it's a house where a house has been demolished and 2 townhouses have been put up, they're considered both new builds, provided they haven't been occupied before. So that's probably a really key thing to look out for. Off the plan purchases count for that as well. But yeah, previously occupied homes, as I said before, freestanding homes that have been replaced with a new build don't count. And again, that also then feeds in substantial renovations, things like that. A gutting flat out the back doesn't count. So yeah, it's really, if you keep thinking of more supply, that's probably the best way to look at it from a new build perspective.
Thank you. So there might be some of the audience, Brent, that are online that might have a self-managed super fund, and it's possible that some of those individuals might also currently hold a residential property through that vehicle or may consider doing so in the future. So in terms of that, we're aware that superannuation hasn't been touched by these changes, but maybe just explain to the audience who do have a self-managed fund what any impacts at all might be the case.
Yeah, thanks, Steve. Because the other thing they noted in the budget is trusts, and anybody that has a self-managed superannuation fund it is a trust effectively, and the big but is superannuation, whether it's self-managed or industry fund or a platform, all superannuation has been carved out of this legislation. So effectively, you could purchase a new property an existing property inside a self-managed superannuation fund after budget night, and the rules continue to apply. So, and of course, if you already have a self-managed superannuation fund with property inside it, again, none of these new CGT and negative gearing proposals apply. So superannuation broadly and self-managed superannuation is like the big winner out of this budget, just by virtue of no change, whereas other assets have become less attractive.
Thanks, Brent. I think just before we move on from that, so Sam, I might just get you to also add. So a lot of people would have heard about self-managed super funds, but I think it's important to understand that even though there's still an ability perhaps to own an existing residential property through that, there's a lot more to consider, not only from an investment point of view, but also from the responsibility perspective. So putting your accounting hat on, what are the things that sometimes individuals don't consider when they're taking out a self-managed super fund in terms of their responsibility?
Yeah, I think the name sums it up. It's self-managed, and as accountants and advisors, we can assist with the management of that and the compliance of it. But there is a lot of responsibility that falls on the individual, the trustee, to do that. They're responsible at the end of the day for making sure that all the various CIS rules are being followed. So they're all the various super rules, which are quite rigid. Probably, yeah, there's a lot of them, and you want to essentially make sure you're following them because the penalties can be really harsh. And also the cost to manage them. Often I'll have clients talk to me about wanting to set up a self-managed super fund and have to go through the various costs and whatnot. So they're aware of how that works because you do need to you're responsible for having financial statements completed for the super fund, having a tax return completed, having that audited. So there is a lot more of a compliance burden on the individual that you don't have on other super platforms.
Yeah, thank you. And I think it's just important to highlight that it's not the same as having a fund that you may normally be in, one of the big funds, that most of the audience are probably in. It's where there is additional responsibility. So with that, what I thought we might now do is focus on the proposed changes around the CGT. So most people would be aware that currently, if you own an asset for more than 12 months in your own name in particular, and you sell that asset, then 50% of that capital gain is assessed for income tax purposes. So what is the government proposing with to CGT to happen under the new rules post, I think, July 27?
Yeah, so essentially as it says on the slide there, it's a split system. So essentially any gains made up till 1 July 2027, that's the magic number, will be treated under the existing rules. And then it'll just be any gain on the asset from that point in time in the future will be assessed under the new rules. So as I said earlier, there's no advantage to selling an asset today in order to be tracked under the old rules, because even if you own it post July 2027, that portion of the gain will still be applied under the normal previous 50% discount. So I guess one question often I've had from some clients and other people is, what is indexing? How does it work? Essentially what that is, it just replaces the 50% discount with increasing the cost base of your asset. So if you have an asset that was worth, cost you $100,000, it'll just be in line with what inflation is. It increases progressively, so you get a bigger cost base. Yeah.
And Sam, just to clarify for the audience, at this stage, the government hasn't really explained what they'll use in terms of that indexation measure, or how they'll determine what that inflationary factor is.
Correct. They haven't announced anything yet. I would hazard to guess that it is just going to be on CPI numbers, which is what indexing was in place previously before my time as an accountant. But it has been in place previously, and normally they'll use the CPI numbers, and they'll have that released quarterly. And it's a formula to do it. So I guess one of the big messages I would say to all the people out there watching is, it used to be fairly simple for us when we'd have a client call up and say, Sam, I'm thinking of selling this investment property. Roughly, what's my tax going to be on it? You could go very high level broadly and say it'll be roughly this much. This is going to make those calculations much more complicated, not only for the fact that we've got to do two separate calculations, but just the nature of having to do the indexing. You've got to really look at the time held and the factor you get to increase it by. So, it's just going to make capital gains tax a lot more complicated for individuals, unfortunately.
Okay, thanks for that. So, Brent, given all that and what Sam just explained around, I guess, the split system, how will the proposed now 30% minimum tax that's going to apply on capital gains so maybe affect the decisions that people make about when to sell an asset?
Yeah, and look, as you said in the introduction, Steve, there's no urgency to make a decision, but you do need to get your house in order and understand the implications. So as Sam said, and look, all of this is going to be based on around the time you're going to sell it. So again, just because these changes occur, it's at sale date. Now, if you think you're going to hold this for another 10, 15 years, then it's probably not a lot to consider right now, apart from maybe projecting forward and trying to do a future value. Big thing is to get the valuation done as of the 30th of June, 2027, to make sure you've got that valuation. I think the big consideration is, what is it that you wanted this investment to do? And with any investment choice, although taxation is not the primary reason that you necessarily invest, it's always a consideration in the Australian environment because tax always comes into play. So I think it potentially changes your potential returns over the long term. And so if you felt this property was going to increase in capital value with this potential taxation outcome at a given time frame, that calculation is going to change. So you just really have to do your sums again.
Yeah, and I think that's a really good message is that just to reinforce to everyone that, again, until the legislation is finalised, no one needs to make any quick decisions, and any of the changes aren't going to apply until until July 2027. So, 13 months away of being part. So I think that's the important thing. There's a lot of noise out there at the moment, and what we're trying to do today is try to remove some of that noise and just slow it down a little bit, because where we're at today and where we might end could look a little bit different.
And I think that point in the slide is there's no one size fits all answer in this scenario. Everyone's got to run their own numbers. Purchase dates are going to impact growth, inflation. So you need to do the sums individually.
Yeah, and I think sorry, Steve, I was just going to say, with the capital gains stuff as well, it's very much in the news and whatnot and can seem very negative. But I think particularly from the 30% minimum tax on capital gains, most client taxpayers will be paying above 30% on their capital gain anyway. It probably just might change your thought process, and it's where you need to speak to an advisor and think things out, particularly if you were holding assets in your personal name in retirement that will realise a capital gain. Again, it's speaking to people about what's the best way to hold those assets so that you're not paying more tax than you have to.
Yeah, thanks, Sam and Brent. That's very helpful. I think so. One of the things Brent and I were talking about recently, and I think we were slightly unaware, but we were talking under the negative gearing rules that new builds obviously are treated differently in terms of negative gearing. But for CGT purposes, are they also treated different, Brent?
Yeah, this is an interesting part of the budget, because effectively they're saying new builds and referring to Sam's coverage of what a new build is. What's unique is full negative gearing is retained for new builds. And again, to Sam's point, what's the government trying to do here? They're trying to encourage people to increase housing supply, which is one of the major underlying factors contributing to the housing crisis. So negative gearing remains as it was previous if it's a new build. You also have a dual method to determine your gain. So you can use you can retain 50% CGT discount, which is pretty generous, but also you can work the indexation method, and whatever gets you the best result you can utilise. So this is all very much about encouraging people to get into new builds and increase supply.
So I think that's a really good point. So it only covers that one particular style of investment. So anyone else has other investment types, Sam, whether that be non-new build properties or whether it be shares that they might own or business assets that they hold, etc. The CGT proposals that you talked about before will apply to those. This has just been carved out as a separate exemption for new builds. Is that correct?
That's correct. And look, I think everyone here that's logged into this have probably been watching the news and whatnot. There's a fair bit of talk and in the media and stuff about there might be potential other carve-outs for things like particularly startups. There's been a lot of talk about, but nothing has been actually formally proposed yet. So this is the only carve-out that they've announced in the budget.
Okay, thank you.
In regard to property, I would just say again, my bias, superannuation carved out.
Well, that's a really good, I guess, segue, Brett, into, you mentioned earlier when we talked about self-managed super funds. But again, I would think the majority of the people who are online today are unlikely to have a self-managed super fund. They're more likely just to have a traditional, what we call public office superannuation fund. And as you said, they operate under a trust structure. So how were those funds impacted by these changes?
Not at all, effectively. Although, I mean, this is how it currently stands and how it stood before the budget. Although nothing changes relative to existing investment property, residential property, this looks better because it obviously retains all the benefits it had pre-budget night. Now, with every investment you can potentially think about, they all have their pros and cons, and what might be a pro for one person might be a con for another. So again, you can't just make absolute statements about if this is good or bad. Obviously, super has its major pros being those retained benefits and the tax incentives both in accumulation and pension phase. But obviously, the con is it's held until you reach a trigger for release. For most of us, that's going to be retirement, and that can only be as early as 60. So now if you're 55, 60, 65, clearly those timeframes are much shorter, taking advantage of those tax benefits that exist pre and post budget are the big win.
Yeah, I think that's a really good message, Brent. Thank you. Although we're saying that, Sam, we're talking the fact that obviously superannuation is a trust. There's also one of the other, and you talked about, business owners a moment ago. A lot of the people, and maybe not too many in the audience, but they could be part of other trust structures if they're a member of a family trust, or they might be a director of a business if they're, their partner or spouse perhaps has a business ownership. So for those individuals, what do these proposals mean?
Yeah, I think the 30% minimum trust tax is essentially designed to stop people flowing income from a trust to a low taxpayer. Like it's very common where people with trust income might distribute it to an adult child that might be at university and not earning any income, so it can achieve a lower tax rate, or a self-funded retiree parent and achieve a lower tax rate there. So I guess what this is changing is it just means that there'll be a minimum 30% tax paid by the trust, so that you won't be able to take advantage of people just having all their trust distribution from a discretionary trust, that is, at either the 0 marginal tax rate or the 15% marginal tax rate. So I think this is, it probably, like I said, doesn't probably apply to a heap of people here, but I think it's a significant change. I think they've missed the mark a bit because I don't think it really will end up impacting the quite wealthy people that use a trust, but it will make a change, and probably just changes the way people think of how they'll structure their investments in the future, whether it be business or just even personal investments that they have outside of super.
I think, again, you're right, Sam. It's probably not going to impact too many people of us on the call, but just to reinforce, for those of us who are employees, who obviously our employer pays tax on our behalf, none of those proposals in terms of the trust changes have any impact on our tax or anything of that nature.
Yeah, correct. It has no impact.
All right. So that covers off probably the two big issues, that were, or proposals that were announced in the budget, both negative gearing and obviously CGT. and I hope those of you who are online have taken some key points that, again, it's not yet legislated. There will be tweaks, we suspect. And most importantly, you don't need to make any decisions today. You've got time to see how it looks and consider that. But we thought it's also important, even though these changes have been made and it might have you thinking about what the impacts are to you, when it comes to building wealth, and at the end of the day, people who are investing in whether it be property or other types of investments to get the benefits of negative gearing or hopefully to get a capital gain, they're doing it to build wealth. So I thought it might be worth, by Sam and Brett, to have a bit of a conversation about more of the long-term benefit or the long-term planning that people perhaps could consider in regards to that. So Sam, I thought I might start with that. So one of the things that I know talking to you over the preparation of this webinar is that often clients might do their tax return themselves, or they might only see their accountant once a year if they're PAY tax earners, being employees. But what are some of the things that people can do in terms of preparing well for their tax return so that they can kind of maximise their tax return each year? What are the things that proactively that you as an accountant would suggest that people give some thought to year in, year out for that benefit?
Yeah, so I think forming good habits is the best way to go about it. And at the end of the day, as an accountant, I don't care really how you keep your records, as long as there's a way that you find that works for you, because we're all very time poor. So if we're trying to think back 12 months ago and find where we spent money on a subscription or a donation we made or whatnot, you're going to end up missing something and not being able to claim it. So again, I've got my clients do lots of different things. Some will pay for everything on a certain card and then write down what it was if it was a work-related thing. Got some that'll have an email address just specifically where they'll take photos of their receipts and email them there, so they've got them in one spot. Folders on their G drive or on their computer. The other day, it doesn't really matter how, as long as you find something that works for you. Because, yeah, in my experience, it's generally everyone's busy and it's too hard to remember way back when. So if you can have some sort of mechanism where you've got the stuff saved at the point in time you incur the expense, it's going to make your life a lot easier.
I think that's really cool. Any other big picture things in terms of managing their affairs or understanding where their spending's going, those types of things?
Yeah, I think I think that's one thing, and then particularly with our clients, by having your records relatively clean and together, then allows us to have, when we are meeting with, whether we're doing a tax planning meeting or a tax return meeting, it allows us to have more conversations about what's actually going on in your life and where you are, how you're structuring up your investments from a tax point of view for the going forward, and what opportunities there might be to save some tax in the future, whether it be looking at your super contribution limits. Again, still property investment, you can still do that in a really tax effective way. Again, not so much through negative gearing, but you can still structure things up in a really tax effective manner, and even share investment, things like that. So I think seeking advice and speaking to people in the area that can help you with it, because I think that can then really put you in a really good place to succeed and at least take control over your financial world, rather than just sort of going through life sort of guessing, I guess.
No, that's, I think, good advice as well, Sam. So, Brett, I might direct this one to you. So obviously we've talked a lot about the proposed changes, and particularly, many people historically in Australia like to build wealth through property and have utilised the negative gearing regime. So with those changes, what are some of the other alternative investment vehicles that that people can consider now as part of building their wealth out?
Yeah, look, I'm going to be a squeaky wheel here and start with superannuation. I look at largely because I have conversations a lot where people consider superannuation last, and again, it's because it's locked up for quite long periods of time. I think people are concerned about throwing more money at it, but there comes a time where I think it should be seriously considered as part of the mix from the beginning, rather than I bought a couple of properties and now I'm thinking maybe I should diversify and super's the other alternative. So I'll start it again. If you're 30, 40 and you're building for a deposit to buy a house, and then you're going to be financially strained, paying down debt and raising families and things, it clearly has its limitations. But it's really well worth reviewing other options like shares and ETFs, because you can still borrow to invest. Now, I understand that people and Australians specifically understand property and more than they believe they understand shares. So that is a limitation, but it's definitely worth looking at that as an option, because you can still borrow to invest, franking credits still occur, and diversification is a big, if we put our financial planning hat on, property is a very concentrated, and with any asset that's concentrated, it brings risks. So obviously via shares and ETFs, you can get a high level of diversification. Yes. So pros and cons. Cons are the market is volatile and you'll see value shift. And I could go on for quite a while. I don't have the time to do it at the moment, but values changing don't mean you've made a gain or a loss. What you're looking for is long-term incremental increases. So commercial property is being to a degree carved out, full negative gearing retained, generally high yields, and tenants cover outgoings, which is a big plus, and obviously reflected in the rent you can have. As we said, new builds. And Sam, I'll throw to you around the corporate structures, because you've probably got more understanding of that.
Yeah, so I guess probably corporate structures is just a way that you would essentially might structure your investment. So you could have property, whether commercial or residential, inside a company structure. Same way that you could have shares or ETFs within a corporate structure. And I guess the benefit for that is you only pay a flat 25% on the earnings for if you're carrying on a business, or 30% if you're not, which is lower than the marginal tax rate that a lot of people might be paying in here. So the beauty of that then is you only need to then pay personal tax at your personal income tax rates on those earnings if you take money out of the company as a dividend. So what they can work really well for long-term investment is that you pay the lower tax rate, and then you get to roll over your investment, essentially reinvest the earnings, and have more in the market there. The other probably thing which we haven't had a chance to really model out yet, but it may give you benefits, particularly in the long run, where you can choose to how you want to pay out dividends from a corporate structure in a really measured manner. Which means then you could take advantage of times where there might be a spouse that's on maternity leave, or someone or you've retired and or you've gone part-time or taken a leave of absence or something, and your taxable income's lower. You could pay a dividend out then and realise it at your lower tax rates. So I think with the change in trust, there's probably going to be more likely an increase in corporate structures. But there is a lot of compliance stuff with those as well. So again, it wouldn't be something I'd want anyone jumping into without having spoken to an advisor that's familiar with how they work, and to explain the pros and cons.
Thanks, Sam and Brent. I think the point that you brought out of that is that there are still many options to build wealth. And Brent, you made a really good point, I think, and what we do every day and the clients that we support, often superannuation is put last in that consideration. And given that, for those of us who are employees, 12% of our income gets put into a superannuation fund under the law. That's a significant amount of compulsory savings, and if you've got a working life of 40 years, that's a significant amount of money that's going to be invested on your or by your employer for you. So given that, I thought it might be helpful just to have a little bit of a discussion. I know we've talked about that the superannuation system is not impacted by these proposals, which is great. It means that the tax concessions that the superannuation environment currently has are maintained. But what are the other advantages of the super system that perhaps people don't give enough thought to, Brent, along the journey of building their wealth out?
Thanks, Steve. One comment I made earlier was when you were thinking about the impacts of these changes to property is understanding what it is you're trying to get that investment to achieve. And that's a big thing people miss when it comes to superannuation. So most Australians are in the default investment option, and that is a quality investment option, but it's not an investment option designed for you. So the first thing I'd say about superannuation is understand what it is you'd like to have by the time you retire and into retirement, and adjust the investments to get the return that you want. There is a discussion to be had there around, most people will couch this in terms of risk, but I'd like to separate out risk and volatility. If you're a 30-year-old, you're going to be invested until retirement for at least 30 years, and then leave it in the pension phase for 30 years. So you are a very long-term investor, and volatility is not necessarily risk over that time frame. In mentioning retirement, the vast majority of Australians don't seem to have it pointed out that superannuation is a lifetime tax structure. It has two phases. The first while you're working, and called the accumulation phase, when that 12%, as you say, is being contributed. Most people don't understand that lifetime structure exists into retirement. So if you leave your money in the superannuation environment, you move it into what's called the pension phase, the second phase of super. The big consideration there is that the tax on returns and drawdowns is zero. So that tax incentive on the accumulation phase, only 15% on contributions and earnings, maximum 15% for a range of reasons, only becomes better when you shift that money into the retirement phase. Again, if you're thinking about SMSF and property, obviously, if you hold the property into retirement and you've structured yourself well and you've got good advice, you might be able to then liquidate that property with zero tax on capital gain. Again, there are many nuances and complications to that. It needs to be a well-planned strategy for a whole range of reasons. So I think they're the major considerations that people don't think about, or think about far too late. Now, it's still a good structure if you first have a discussion about this when you're 65 and retiring, but it's a much more fruitful conversation if you have it when you're 30 or 40.
Yeah, and I think what's on the screen there, Brent, there's also some contribution strategies that people also can use. So without spending too much time on it, obviously what we call the concessional contribution caps increasing from July, so that provides greater lift for people. But maybe talk about just a couple of the other things that people may not be as familiar with. For example, maybe the bring forward non-concessional rule.
Yeah, these are really interesting. So every year you have a concessional cap, and they've been going up, as you see at that top bullet point. There'll be 32,500 in the 2026 financial year. But what the carry forward unused caps is that if you've got a balance under 500,000 in your super, and you haven't utilised up to that cap every year, you can look back and take advantage of the gap in each year. Now, you've got to actually max out this year's cap first before any additional contributions can be attributed, and they are always attributed to the oldest year. And if nothing else, think about this before 30 June, because that fifth year will drop off as we turn over into the new financial year. So if you had 10 grand cap that you wanted to use, that will not exist on the 1st of July. So it's a really important one, especially for people closer to retirement and balances under 500,000.
So it's a great way to catch up a little bit.
Absolutely. It's got to catch
It's
up
great.
for that reason.
Great way to just take advantage of the difference between your personal marginal tax rate and the 15% that you pay in super. It's particularly if you're still working and you're older and closer to being able to access your super, it's a little bit of a no-brainer often to me, where you can just essentially get a tax saving from moving it from yourself to your future self.
Excellent. Thank you, Brett and Sam. So on that, just before I bring in Nick West, who has been monitoring question time. So again, I hope that's given everyone a bit of an overview of the proposed changes, the things that you might need to think about, the fact that there's more than one way to build wealth, not just through the property market, obviously, not discounting how successful that's been for many people within Australia. But again, I think hopefully you've got a bit more of an understanding of some of the things that you can consider and can do, and also the importance of your superannuation fund, and maybe, taking a little bit more ownership around your understanding and looking into the options that you've got there. So with that, I will pause and I'll bring Nick in, who's been monitoring the questions, just to share any questions that the audience has had. Thanks, Nick.
Yeah, thanks, Steve. A couple of questions have come through. So first one's for you, Sam. Do you think landlords will increase rents to offset the removal of negatively geared property?
I obviously can't speak for all landlords, but history would say that they likely will. And probably, I guess, one of the factors with that is the sense that there's such low rental vacancy rates in all the major cities at the moment. So it's highly competitive for rent as it is. And just for the people watching, to put in perspective, if someone's a top taxpayer and they've got a rental property, if they increase their rent and they're able to get the benefits of negative gearing, if they increase their rent $20, they essentially only would get to keep $10 of that. So whereas now they'll actually keep the $20. So it probably it's more valuable to them to increase rent, where previously they'll go, oh, I'm only keeping half it. Who cares? They're good tenants, we'll keep it there. But yeah, I imagine people will possibly, but we might not see it for a little bit of time until there's the new properties that aren't subject to the negative gearing rules. But who knows? I guess it's the short of it.
Thanks, Sam. I've got another one for you, another property one. If you change your primary residence that you own prior to the 1st of July 2026 to a rental after that date, can it be negatively geared?
Yeah, really good question there. And the answer is yes, it can be. So I bet, so yeah, any property owned prior to budget night you can take advantage of the negative gearing benefits. One thing to just consider with that, and I think that's a good message for everyone, is that if you've paid your mortgage down significantly, even if you redraw or use the equity in that home you've got to borrow, that new borrowings cannot be applied to rental income. It's only the original borrowings that you had. So, but yeah, in short, Adam, yes, you could apply the negative gearing if you change your primary residence over.
Okay, thanks, Sam. We've got a couple more questions that have just come in. Over to you, Brent. What is the advantage of non-concessional contributions into super?
So this goes back to my comments about the tax advantages that increase when you go into pension phase. So most people are using non-concessional are closer to retirement, and the only way you can get money into the pension phase is if it goes through the accumulation phase and transfers across. So where do we see people using this? People who have got accumulated savings that are above the concessional caps, but they want to get them into pension phase, they could use them. people who get inheritances, which are usually large lump sums, that they want to sneak into the accumulation phase before they retire and go to the pension phase, remembering that tax on earnings and drawdowns are zero when you're in the pension phase. So they're about getting big lump sums into the accumulation phase before you go to pension. Now, it's not to say somebody younger couldn't do that, but I think there are potentially better strategies, and I suggest give me a call and let's talk through those individually.
And I'll just add one small thing there. So the advantage of superannuation, and Brent's talked about some of the trade-offs if you're a long way from being able to access it, but the superannuation fund, if you make the earnings are taxed at a maximum of 15, where if you're investing it in your own name, it could be as high as 47% depending on your earnings. So that is in the tax sense, it's the simple answer, and then all the other considerations that Brent obviously, added there as part of that.
Yeah, and I'd just add that people put that money into super because they know it's earmarked to fund their retirement. If you need any of that lump sum before retirement, then super's not your vehicle.
Thanks, Brent. Got another one for Sam here. Is the property valuation as of the 1st of July 2027 tax deductible?
I'd love to be able to tell you that answer, but we don't even know what the valuation needs to look like, to be honest. On the normal deductibility rules, I would suspect that it most likely would. There's a risk that it might be capital in nature, which just means it goes to your cost base. But until we actually know what the nature of the valuation people require, can't really answer that affirmatively.
Brent, one for you. Having shares outside of super, how will they be affected under the changes?
The capital gains tax rules. Actually, Sam, I think this is better for you to answer.
Okay.
Yeah, look, so it'll be, so if you've got shares outside of super, so either in your personal name or through a vehicle, they'll be subject to the new capital gains tax rules, which essentially means that from 1 July 2027, their capital gain will be, the cost base will be indexed and their capital gain will be calculated. Just from a high level point of view, I know I've been having discussions with my clients already. I foresee there being much more clients who use equity that they might have in properties already and borrow against that to invest in shares so they can claim the interest on that and increase their investment in the share market. Has been a conversation we've been having with clients already.
Thanks, Sam. I'll leave this one for either of you to answer. There's been a lot of negative talk in the press about the budget changes. Are there any winners as a result of the changes?
Well, broadly, those other asset classes we've already talked about. And largely, this is one of the things the government's trying to do. We spoke about increasing housing supply, but one of the long-term drags on the economy, which was foreseen by some people when they introduced these capital gains tax rules and negative gearing, was it would divert too much money away from production into passive assets like housing, which is as it's turned out. So to a degree, although as in some asset classes hasn't changed, the benefit is it's going to sort of direct dollars and investment into those sort of assets. So I think they relatively look better.
Just a quick one. And I would probably say, selfishly, accountants and financial advisors are probably the big winners out of this because it's made everything a lot more complicated. And I think, look, the sad thing about it is I think it's going to create a bigger gap between those that have already accumulated or have substantial assets where they can get tailored advice and do things in a really strategic, measured manner and take advantage of the changes. Whereas a lot of people that are still on their journey accumulating, they might not be engaging with advisors as much, and therefore fall behind a bit. Like, I think naturally you had a pretty high floor in the sense if you owned your house and you had some excess funds, it was a fairly simple strategy to copy your mate and go buy a property in negative gear, and there was a fairly high floor for doing that. Whereas now, it's going to be, there's a lot more strategy that needs to be involved. So hopefully out of these changes, that people still seek advice and try and find ways where they can get themselves ahead through measured strategies.
Look, it's a really good point, Sam. I just suppose I'd add to that it's not as straightforward just to sort of copy and paste, go and buy investment properties, because there's a lot more considerations in the way it's structured, and your result isn't as, I'm going to say, it doesn't appear as lucrative. Can I just say though that over my 20 or 30 years of working in this area, there's been numerous times where I've been sitting in the confines of a room with just one other person who said, I've bought an investment property and it's gone nowhere for 10 years, or actually we sold it at a loss and we're working into our 70s because we're in debt. So it's not a given just because you bought a property in the past that it would be lucrative. And that is less the case going forward under these new rules.
And I think this is sort of not tax, but I think that's a real risk with the carve out for new supply of property. I foresee there being a lot of not fantastic developments that potentially people invest in because they want to take advantage of the tax advantage, but then don't think about the capital growth point of view and like who they're going to, when they want to realise that asset, who are they going to sell it to, because it's not going to be as attractive to another investor. So where's their capital growth going to come from?
Thanks. Steve, just conscious of time, one more's come into the Q&A. Do we want to answer that via email, or do you want to wrap it up now?
Before we finish it up, let's make this the final question.
Yep.
Okay, sure. I'll just read it out. For a married couple, are capital gains tax rates applied to individual income or household income, or is this dependent on how the asset was purchased, i.e. jointly or individually?
I'll grab that one. So yes, it depends on how the asset's owned. So if it's owned 50-50, then half the capital gain will be reported on each your income tax returns. If it's owned 100% in someone's name, then it will all the capital gain will go to them.
Thanks, Sam. All right, well, that brings us to the end of today's webinar. Thank you everyone for joining us. I'd like to thank Sam and Brent also for their expertise and providing their insights into the proposed budget changes. Obviously, we hope you found the session practical and valuable as you think about the next financial steps. If you do have any questions or want to explore any of the things that have occurred in more detail, you can see our contact details are on the screen, so please don't hesitate to reach out. And with that, I will say thank you and goodbye.
Thanks, everybody. Thanks, Sam.
Thank you.
Thanks, Steve.